market news now. Global stock markets moved in opposite directions as European investors responded to strain in the U.S. banking sector. But Wall Street futures rose on bullish updates from Microsoft and Google parent Alphabet. Locally, the JSE was weaker this morning with its global peers mostly down after a disappointing earnings report from First Republic Bank reignited concerns about the broader banking sector. Shares in troubled San Francisco-based lender hit a record low as it disclosed a $100 billion plunge in deposits, reviving fears over smaller U.S. banks that began with Silicon Valley Bank's March collapse. To talk to us about the latest when it comes to the markets with a specific focus on global markets, we are joined by Lukman Otunuga from FXTM. Lukman, thank you so much for your time. Let's start off with a conversation around the narrative when it comes to inflation, especially as you look at what is happening on the US and the UK side.
Thanks for having me here today, Nastasia. Yeah, we've seen signs of easing inflationary pressures in the United States thanks to falling energy prices. Annual inflation rate has actually dropped for the 9 consecutive period in the United States, fueling speculations around the Federal Reserve cutting interest rates in November or December. Well, it's a different story here in the United Kingdom. You know, inflation still remains around 10%. This is 5 times above the Bank of England's 2% target. And to be frank, you know, the terrible combination of high inflation and high interest rates continues to squeeze households across the UK. The Bank of England, unlike the Fed, has a lot on its plates and is expected to continue raising interest rates throughout 2023, which essentially could impact growth in the UK. But ultimately, looking beyond the Fed and the Bank of England, there is a lot of talk about the global hiking cycle coming to an end after inflation in general has peaked. And this could ultimately usher a period of lower interest rates, if not by the end of 2023, early 2024.
When you look at the different asset classes, I mean, is there parts of the market that is anticipating an economic meltdown?
The first thing that comes to mind is the bond markets. It's widely known that we've seen the 10-year Treasury yield, you know, it's been below the 2-year since last year summer. And, you know, when we're talking about the inverted yield curve scenario, this is a situation where the long-term interest rates are, you know, shorter than the short-term interest rates. In black and white, what I'm trying to say is investors are moving their money away from short-term to long-term burns. And fun fact, every single time, most times when an inverted yield curve situation happens, you know, it does signal a recession around the corner. Looking at stock markets as well, stock markets are roughly up, you know, year to date. However, you know, if concerns continue to intensify for the global economy, despite what we're seeing in earnings seasons, this could hit stocks. But I think most importantly, looking at safe haven assets like the dollar, the yen and gold, gold is up over 10% year to date, and any signs of a global recession could encourage the precious metal to shine through the chaos.
It's quite interesting. You mentioned the yen. Let's talk about the performance of the yen, at least for the month of April, especially now that we are going into the Bank of Japan's interest rate decision later this week.
Yes, the yen has certainly been on my radar. It's been a rough month for the safe haven currency, thanks to the fact that the Bank of Japan still maintains its ultra dovish policy, and the easing banking fears have sent investors away from, you know, safe haven destinations. The Bank of Japan policy meeting this Friday is a big deal because this will be the first policy meeting under the new governor, Kazuo Ueda. You know, despite Japan's consumer inflation, you know, rising, you know, above its target, we don't really expect the central bank to change its monetary policy or do anything to its yield curve control. However, though, with the new Bank of Japan head, you know, signals, you know, that the future guidance could move towards neutral from dovish. This may plant the seeds of tighter monetary policy down the future, ultimately supporting the Japanese yen. So I've got my eyes on Friday.
I know a while back you and I discussed the dollar and whether we had reached peak dollar. And then I suppose the question now is, what do you believe will be the drivers for the US dollar, whether, you know, up or down?
Certainly, looking at the dollar's year-to-date gains has been really mixed, and 2023 could mark the period where King Dollar gets taken off its throne. Last time we spoke, some time ago, the primary drivers that were supporting the dollar was an aggressive Federal Reserve, safe haven appetite, and the fact that the US economy was doing quite well. And now all these factors were switched. The Fed is expected to pivot by Q4 2023. there's still ongoing concerns over the US economy, and investors are looking elsewhere to the yen gold for safe haven. I think moving forward, though, dollar weakness most likely will be a key thing moving forward, but it all depends what the Fed says after the Fed policy meeting in May.
We are expecting first quarter GDP numbers out of the US. What are you going to be keeping an eye on when that data print comes out?
Yeah, absolutely. Looking at GDP, so it's expected to actually moderate down from the 2.6% so in the previous quarter to around 2% quarter on quarter. This is really disappointing, and ultimately what we'll be looking for is, if the results meets or prints below expectations, this could provide investors that key insights to what the Fed is going to do beyond May. Right now there's still speculations around, the Fed pivoting, but another set of disappointing economic figures, especially GDP, could reinforce the argument that the Fed has finished hiking in May, and moving forward, the Fed's going to pause and start cutting interest rates by the end of 2023.
Before I let you go, with just under a minute left, are we still talking about the China reopening story? Is that still a thing?
Yeah, I mean, a few weeks ago, China swept markets off their feet with stronger than expected GDP growth, but that optimism was dampened by the fact that this was an uneven recovery with some weakness in the industrial manufacturing sector. And digging deeper, it looks like the impacts of COVID-19 are still lingering in China's economy, with consumers remaining quite cautious of spending. On top of this, looking at the economic data, we've seen that, falling Chinese exports have been a theme due to slower economic growth from the United States and Europe. And the icing on the cake, ultimately to add to it, there's still concerns that, the real estate market, China's real estate market, it's not really fully recovered from the chaos we saw last year. When we combine this all together, even though there's optimism, I think we need to look for more data for China's economic recovery.
Lukman, let's leave it there. Thank you so much for your time. That is Lukman Otunuga, who's a senior research analyst at FXTM. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.